Hello, a warm welcome to all of you for this revision program on financial operations. You're with me, Damitha Ukuwela. I will be taking you through the syllabus structure of financial operations, and then we will be focusing on some key areas that will be quite important for you at the examination in May 2014. When we look at the syllabus, it has got, as you can see, the three key areas in the syllabus: principles of business taxation, amounting for 25% of the syllabus, regulations and ethics of financial reporting, amounting for 15%, and finally, financial accounting and reporting for 60% of your syllabus. Now, principles of business taxation is a very important area in the syllabus because it's something that's quite important in terms of getting through the examination because the questions are quite easy and the questions are quite straightforward. Mainly in section A, the MCQ section, and section B, the 5-mark question section, will comprise of questions coming from principles of business taxation. One key area in business taxation that most of the students are not very comfortable is international aspects of taxation. So I would like you to take you through these international aspects of taxation, explaining to you how international aspects of taxation are being identified in your syllabus and what are the key areas in your syllabus when it comes to international taxation. International taxation is something that will affect an organization when they deal with businesses in more than one country. If you are doing business activities in just one country, then you are not really going to get affected by international taxation. However, if you are in a situation where you do business activities in more than one country, you are likely to get affected because of international taxation. Sometimes businesses are resident in one country. When I say resident, they are incorporated or having their head office, the board meetings are carried out in one country, whereas they may be having an extension in another country. For example, it might have a branch office in another country, or it could be a subsidiary. So when you have a situation like that, it would be a little bit of a complicated tax structure to identify where exactly this organization is supposed to pay their taxes. When we look at the corporate residents, the worldwide approach in terms of corporate taxation is that the entities normally pay taxation on their worldwide income in the country they are resident in. When we say worldwide income, that will include the income that they generate in their country of corporate residence, as well as any income that they generate from overseas countries. Normally, when it comes to determining the corporate residence, we look at the country where control is being exercised. Generally, an entity is resident for tax purposes in the country of control. When we say country of control, it's all about the country where the head office is located and where the board meetings are being held. So how come this is going to be a problem? If a company earns an income in a foreign country, it will be required to pay tax in the country of earning. Say for example, a Sri Lankan company having a branch office in India. A Sri Lankan company, when it is having a branch office in India, the Indian tax authority will ask the branch to pay taxes on whatever the income that is earned through the branch itself. But then again, the branch is an extension of the Sri Lankan operation, so when that income is being taken back to Sri Lanka, the Sri Lankan tax authority will again levy taxation on that income. So this is where double taxation is applicable. Same income subject to taxation in India as well as in Sri Lanka. So this is not something that is fair, because it is the same income that is being taxed in two different places. Because of this, countries have come up with various agreements. We call them tax treaties, where an agreement is signed between two countries, tax authorities of two countries, to provide some form of relief to avoid double taxation. As you can see, according to the worldwide approach, an entity is subject to tax in the country of residence on their worldwide income. This leads to double taxation, where same income is taxed in the country of earning and in the country of corporate residence. So when we look at the ways in which relief is granted, there are three main ways of providing relief. The first one, as you can see, is exemption. If a particular income is taxed in one country, it will be exempted in the other. if a particular income is taxed in one country, it will be exempted, or in other words, it is not going to get taxed in the other. The second approach, we call it the tax credit method, is the most practical one and the one that is used more often in countries. If tax is paid in one country, the foreign taxes that are being paid in that country will be made available as a relief. Tax paid in one country will be deducted from the tax payable in the other. When relief is granted, the tax credit that is made available will be the lower of foreign tax or the country of residency taxation. And the third relief method is what we refer to as the deduction method. Foreign tax is deducted from foreign income. Whatever the income you generate out of a foreign country, whatever the foreign taxes you pay will be deducted from this foreign income, and only the net amount is subject to taxation. When we say foreign taxes, there are various types of foreign taxes that we need to consider. However, for your examination purposes, there are only two types of foreign taxes that will be discussed. The first one being withholding tax. It is a tax that is deducted source before payments are remitted overseas. For example, withholding taxes are levied on dividends, interest, etc. And it is the net amount that will be paid to the beneficiary in the foreign country. What is this net amount? Net amount is the amount that is after deducting the withholding tax element. So you take the dividend, you deduct the withholding tax amount, and the net amount or the balance will be paid back to the shareholder in the overseas country. When we look at this system, one might ask the question, why are we deducting a tax like this? We often see that certain business organizations coming to certain countries, doing business activities, and then without paying a single cent as taxes in that country, they transfer all their profits out of the country in the form of dividends. Remember, once money goes out of a country, it's gone and we cannot recover it back. So before the money is remitted overseas, the local tax authority in that particular country will require a particular amount of tax to be deducted at source. Tax at source means a tax is deducted before the payment is being made out. For example, even in PAYE, pay as you earn, we see that tax is deducted at source. Before the tax is paid, before the salary is paid to the employee, the employer is supposed to deduct the tax amount. So the employee has no choice. There's no option available. The tax is deducted and the net amount is what is being paid to the employee. Similarly, withholding tax applies in the same manner. The tax amount is deducted before the dividend is being paid to the shareholder. The other form of foreign tax is underlying tax. Now, most students sometimes think that underlying tax is a tax that you are supposed to pay, just like your VAT, just like your income tax, just like your corporate tax. Not to be. With the underlying tax element is not something that you're supposed to go to the tax office and pay to the tax authority. It is actually a tax that you have suffered, already experienced. Now, when a company is paying a dividend to their shareholders, a dividend comes out of profits after taxation. Remember, profits after taxation. That means the profits that we are distributing as dividends has already experienced taxation. Already experienced taxation. That means tax has already been deducted. So when the tax has already been deducted, the profits that are being distributed will already have suffered some form of taxation. In other words, profits distributed as dividends will have already suffered tax on profits. Therefore, underlying tax is the element of corporate tax, that is the corporate tax element on the dividend. When we look at the formula, you can see the gross dividend is multiplied by the tax on profit of the foreign company, and then you divide it by the profit after tax of foreign company. So that is the way in which we calculate underlying tax. Let's go for a break and then continue with the rest of it. Welcome back. Before the break, we were discussing about underlying tax. We said that the dividends are paid out of profits after tax. Profits are distributed as dividends, which will have already suffered tax on the profits, and therefore underlying tax is the element of corporate tax on the dividend. As you can see, the formula of calculating underlying tax, which is very important for the examination, gross dividend multiplied by the tax of profit of the foreign company. Remember, this is the tax of the company that is paying the dividend, not the tax of your company, not the tax of the shareholder. It's the tax on the profit of the foreign company. You divide it by profit after tax of the foreign company. Here again, something important for the examination, often the examiner gives the profit factor as the profit before tax. Most students end up considering the profit before tax in this calculation rather than or forgetting to deduct the income tax amount from the profit before tax. So remember, when a question is given to calculate underlying tax, you need to check and see whether the profit that is provided, is it profit before tax or is it profit after tax? If it is profit before tax, you're supposed to deduct the tax element to determine the profit after tax. So as we discussed before the break and what we have been discussing so far, we see that international aspects of taxation is quite a very important area in the examination. International aspects of taxation will involve determination of the corporate residence. It will involve double taxation relief. It will also involve the discussion on the types of foreign taxes. You have two types of foreign taxes in your syllabus, one being withholding tax, the other one being underlying tax. So let's take a look at how this area is examined by your examiner. This question is from a past paper. As you can see, HC resident in country X. Remember, for your examination, all the taxation questions involve the concept of country X. The tax tables are given at the beginning of the paper. It's available on the internet now. On the CIMA site, you can view the tax tables. Please take a look at it before you go to the examination. Don't wait till you go to the examination to take a look at the tax tables. It's available now, so get the maximum use out of it. HC, resident in country X, owns 100% of OC. So you can see HC is the parent company, OC is a subsidiary, the fully owned subsidiary, 100% owned, fully owned subsidiary. OC is in a foreign country and it has a double taxation treaty with country X. A double taxation treaty means a double taxation agreement. Relief is provided using the tax credit method. OC reported a profit before tax of 600,000. Remember, it's profit before tax. And when we are calculating underlying tax, we got to consider the profit after tax. It's profit before tax that is given here, 600,000. And the corporate income tax element is 126,000 for the year ended 31st March 2012. OC paid HC, the parent company, a dividend of 200,000 gross. Now what is gross dividend? Gross dividend is the dividend before withholding tax deduction. Gross dividend is the dividend before withholding tax. Net dividend is the dividend after withholding tax, which was subject to a withholding tax of 12%. Tax rate in country X is 25%. Two requirements. First one, calculate the total foreign tax on the dividend. The second one, calculate the amount of tax HC will be liable to pay on receipt of the dividend in country X. Total foreign tax. As we said, total foreign tax comprises of two elements, withholding tax and then you have the underlying tax element. Now earlier we said the dividend, the gross dividend amount is 200,000. On this gross dividend, there is a withholding tax of 12%. So when we are calculating the withholding tax element, that will be 12% of 200,000, which amounts for 24,000. 200,000 at 12%, we get 24,000. And then comes the underlying tax calculation. Remember the formula, gross dividend multiplied by income tax of the foreign entity divided by profit after taxation. Gross dividend. Gross dividend is 200,000. Multiplied by the income tax element, which is 126,000. You divide this by the profit after tax. As it is given in the question, 600,000 is the profit before tax. Remember, we need profit after tax. So from the 600,000, we got to deduct the income tax element of 126,000, then only we are getting the profit after tax. So considering all three, the gross dividend of 200,000, 126,000 income tax, and the profit after tax, we will end up with an underlying tax element of 53,165. Adding this 53,165 with the withholding tax of 24,000, the total foreign tax element is going to be 77,165. 77,165. So let's revisit the calculation again. Withholding tax, underlying tax, these are the two foreign taxes that we are supposed to calculate. Withholding tax is 12% of the gross dividend, 24,000. Underlying tax, you take the gross dividend, income tax divided by profit after tax, you get 53,165, and the total foreign tax comes up to 77,165. So that's the first part of the question. Calculate the total foreign tax. The second part of the question asks you to calculate the amount of tax HC will be liable to pay on receipt of the dividend in country X. Calculate the amount of tax HC will be liable to pay on receipt of the dividend in country X. So let's see how this calculation is performed. Remember, the dividend that is received by HC is 176,000. How come this is going to be 176,000? The gross dividend is 200,000. On this gross dividend, 24,000 will be deducted as withholding tax. So this amount is the amount that is paid to the shareholder. HC is receiving the net amount, which is 176,000. So to the 176,000, we are adding back the withholding tax, which will give us the gross dividend at 200,000. And to the gross dividend, we are going to add back the underlying tax element, 53,165, which gives up 253,165 as the taxable income. Remember, this area is quite confusing and a very important area because it has changed recently. Sometime back, when performing this calculation, we were not supposed to add back the underlying tax element. But now, the tax standards have changed. The way in which we do the calculations have changed. So in the recent past, from 2013 onwards, we are supposed to add back the underlying tax element. So very important note, when we are doing past paper questions, the earlier ones, 2011, 2010, when you check your answers with the examiner's answers, you will see that examiner has not added the underlying tax element. It's not a fault of the examiner, it's something that never existed at that time. But now we are supposed to add back the underlying tax element. So that is what we are doing here. To the gross dividend of 200,000, we are adding back 53,165. That is the underlying tax. So on the 253,165, in country X, you are supposed to pay tax at 25%. 25% of 253,165, as you can see, will come to 63,291. 63,291. But then again, there is a tax credit available. There is a double taxation treaty. A credit is available. The credit needs to be deducted. The credit needs to be deducted before you determine the tax that is payable in country X. So how much are we supposed to deduct? When you look at it, the tax you are supposed to pay, your tax liability in country X, is 63,291. But then again, the foreign tax element that you experienced in the other country came to 77,165. Important point to note here is that when relief is granted, the relief amount will be restricted to the lower of the foreign tax paid and the amount due in the country of residence. Country of residence is country X. Tax due in country X is 63,291. Foreign tax is 77,165. We go for the lower figure. Lower figure is 63,291, which is equal to the tax that you are supposed to pay in country X. So when you deduct it, there will be no tax that is payable in country X. We'll go for a break and then continue with the next question. Before the break, we were looking at a question on international aspects of taxation, which was purely based on calculations. But then again, examiner can ask you for a theoretical explanation involving a complicated tax structure, a pure theoretical question. So let's take a look at a question that has been tested by the examiner. As you can see, OW is an international entity that has operations in two countries. Operate in two countries. OW has a number of branch offices in country X. Each office provides services to customers and sells OW's products. OW's head office is in country X, where OW's production facility and the head office are located. All board meetings are held in country X. Assume country X and country Z have a double taxation treaty with each other based on the OECD model. Now remember, according to the OECD model, if you are supposed to get taxed in a particular country, the first thing is you need to have a permanent establishment. When you look at OW, they do have a branch in country Z. And according to the OECD model, a branch itself is a permanent establishment. At the same time, they have the head office located in country X, which is good enough, and at the same time, they do have their board meetings in country X itself, which is going to be another permanent establishment. So you can see this particular organization, OW, they do have permanent establishments in country Z as well as in country X. So let's take a look at the requirement. Two requirements here, one for 2 marks, another one for 3 marks. The first one, explain with reasons which country or countries OW will be regarded as resident in for tax purposes. Resident for tax purposes. Corporate residence, that's what we are looking at. Corporate residence can be there only in one country. You might be doing business activities in many countries, but only in one country that you will be deemed to be resident for tax purposes. Now, how to determine the residence? According to the OECD model, we look at a couple of things to determine the corporate residence. The first thing, or the most important thing that we consider, is the country of effective management control. What is country of effective management control? Where your head office is located, or where the board meetings are being held. That is your country of effective management control. Sometimes it might be difficult for you to find out where exactly the board meetings are being held or where the control is exercised from. In that case, as the last resort, you will end up selecting the country of incorporation or country of business registration as the country of corporate residence. But here in this case, we don't have a problem like that. It specifically says that OW's head office is in country X, where OW's production facility and head office are located. So head office is in country X. All the board meetings are held in country X. So that is good enough information for us to determine that this particular company OW is going to be resident in country X for tax purposes. So when we look at the question, explain with reasons, which country or countries OW will be regarded as resident in for tax purposes. Your answer should be OW will be resident for tax purposes in country X. Why is that? Because OW's head office is in country X and OW's all the board meetings are held in that particular country. And that is where effective management control is exercised. So that's your answer for the first question, which will enable you to get a couple of marks. When you look at the second requirement, explain how the profits made by OW in country Z will be taxed. So let's go back to the data given to us. OW is running a branch office in country Z. According to the OECD model, a branch is a permanent establishment. So any income that is earned by a branch will have to pay taxes in that particular country itself. In the country of earning, even though the residence is in another country. As we discussed earlier, OW is resident in country Z, country X rather. But then again, a branch is a permanent establishment. As a result, whatever the income the branch is earning, they will have to pay taxes in country Z itself. So how is it going to work out? Whatever the income branch is earning, it will be taxed in country Z. This income will then be taken back to country X, because that is where the head office is located, that is where the main business is being carried out. So once this income is taken back to country X, it is the corporate residents and the tax authorities of country X will require OW to pay taxes, including the income that is generated from the branch. So the branch income is likely to face double taxation. First in country Z, country of earning, and then in the country of corporate residence in country X. So we have a problem. Income earned by the branch is going to get taxed in two countries. So what are we going to do? We don't have much of a problem here, because both countries, X and Z, they do have double taxation treaties, a tax agreement between the two countries, which is in line with the OECD model. So what are we supposed to note here? When you have a tax treaty, the branch income will get taxed in country Z, but when that income is taken back to country X, there will be a double taxation relief that is available. It could be a deduction, it could be an exemption, it could be a tax credit. Usually it's the tax credit method that is being followed, and we saw earlier how the tax credit method actually works out. When there is a tax credit that is available, the foreign taxes paid, the tax you are supposed to pay in the country of residence, you take the two figures and then you take the lower amount, which will be used as the credit, and it will get deducted from the tax that you are supposed to pay. So that's how this is working out. The branch is taxed in the country of earning, income will be taken back to the country of residence, relief will be made available because of the double taxation treaty that is available. So that's one key area in your syllabus, international aspects of taxation. We discussed how the corporate residence is determined. We discussed how the international aspects of taxes are being calculated, the withholding taxes, the underlying taxes, and then we looked at a couple of questions as to how this area is examined by the examiner. Another area in your syllabus, a very important area, will be the accounting standards. Now, why are the accounting standards so important? Accounting standards will account for 60% of your marks, 60 marks out of 100. In other words, without accounting standards, it's impossible to pass this subject. It's impossible to get through this subject. So let's take a look at the key standards that we are supposed to learn, that we are supposed to know in our subject. We have IAS 1, IAS 2, IAS 7, 8, 10, 11, 12, 16, 17, 18, 23, 24, 32, 36, 37, 38, and 39, followed by a few IFRSs, IFRS 3, 5, and 8. Quite a big list in terms of accounting standards, but from an examination perspective, there are key ones that you are supposed to note. IAS 16, property, plant, and equipment, is a very, very important standard. It's tested in every examination diet. This is where you are supposed to account for depreciation, you're supposed to do accounting adjustments when it comes to revaluations, etc. Another very important standard from an examination perspective is going to be IAS 38, intangibles, development expenditure, research expenditure, how to account for development cost, how to account for research. This is being discussed in IAS 38. Then we have IAS 36, impairment of assets. What is the maximum value of an asset that we can recognize in the financial statements? How are we to account for an impairment? Are we going to take it to the income statement, or are we going to charge it against the revaluation reserve? That is what we are going to discuss in 36. 32 and 39 will talk about the financial instruments, another key area, something that is being tested quite often. And finally, IAS 10, even though the standard is quite small, it's again something that is tested very often by your examiner. So let's go for a break, and after the break we'll be looking at some key accounting standards in your syllabus. Welcome back. Before the break, we were discussing about the examinable accounting standards. So let's quickly go through these standards again. IAS 1, preparation of financial statements. IAS 2, inventories. IAS 7, cash flow statements. Then we have IAS 8, accounting policies, estimates and errors. Then we have IAS 10, events after reporting date. IAS 11, construction contracts. 12, quite important, income taxes. 16, property, plant and equipment. Then we have IAS 17, which is on leases. IAS 18, revenue recognition. 23, borrowing costs, a very short standard. 24, related party disclosures. 32, financial instruments. 36, impairment of assets. 37, provisions, contingent liabilities and contingent assets. 38, intangible assets. And finally 39, IAS 39, financial instruments, recognition and measurement. Then we have 3 IFRSs in our syllabus. IFRS 3, business combinations, quite important with consolidated financial statements. IFRS 5, discontinued operations and non-current assets held for sale. And finally IFRS 8, operating segments. So as I discussed before the break, there are few key standards tested heavily at your examination, namely IAS 16, 36, 38, 32 and 39 together, IAS 10, and final one is IAS 12, income taxes. So let's take a look at the first important standard, IAS 16, property, plant and equipment. When we say property, plant and equipment, we are talking about the tangible assets, tangible non-current assets in our organization. Tangible non-current assets, those assets that do have a physical presence. The standard indicates to us how they should be accounted for, how the accounting is being carried out, how will the depreciation will be accounted for, and how will the revaluations will be accounted as well. As you can see, the initial recognition will always be at historical cost. Having said that, before you recognize an asset in the financial statements, you must ensure that the asset meets the definition of an asset. Now, what is the definition of an asset? A resource that is controlled by the organization as a result of past events from which future economic benefits can be generated. Future economic benefits can be generated. And also, you must have a reliable estimate in terms of the cost that you have incurred on your asset. So initially it's at historical cost. What do we mean by historical cost? Generally, when we say historical cost, most people think that it's the purchase price. But then again, it's not just the purchase price. The definition of historical cost goes way beyond the purchase price. The historical cost or cost of an asset includes the cost incurred or all the costs that you have incurred in bringing the asset to its current location and operating condition. Say for example, you are buying a machine from another country. Your supplier is located in another country. Supplier is quoting, let's say $100,000 for the machine. Just because you pay the supplier $100,000, the machine is not going to come to your organization and it's not going to be operational. And as long as it is not there in your organization and it's not operational, you cannot say that it's an asset of yours because it's not going to generate any benefits for you. So you pay $100,000 initially, you need to pay for other costs to ensure that the asset comes to your organization, and more importantly, you are able to generate benefits out of it. When we look at it, transportation cost, for example, freight charges, installation cost, site preparation, some professional fees, certain taxes which are not recoverable, right? Say for example, if you are acquiring a land you are supposed to pay a tax to the government in the form of a stamp duty. What will happen if you don't pay the stamp duty? If you don't pay the stamp duty, you will not be identified as the owner. The ownership will not be transferred to you because the government requires a fee in order to transfer the ownership to you. So that tax is payable. If you don't pay the tax, you are not going to get the ownership. Any cost incurred in bringing the asset to its current location and operating condition must be included when you are determining the cost of an asset. So it's not just the purchase price, it will go beyond that. It will go beyond that. So initial recognition as indicated in IAS 16 is at historical cost, definitely at historical cost. But when it comes to subsequent measurement, now what is subsequent measurement? Subsequent measurement is what you are supposed to do at each accounting period, at the end of each accounting period, at each reporting date. According to the standard, you have a choice here. You have a choice here. If you want, you can continue with the historical cost. The original amount that you recognize at the time of initial recognition, you keep it as it is, and then you continue to account for depreciation on the historical cost. Depreciation, of course, you can calculate using the reducing balance method or the straight line method. But alternatively, the other option that is available to you is to go for the revalued method, asset revaluation. What exactly is a revaluation? Revaluation, in simple terms, can be identified as recognizing an asset in line with the market value. In line with the market value. One might have a question, when we have the historical cost, why should we come up with a revalued amount and complicate matters? Look at something like this. A company has purchased a piece of land 30 years ago. As you know, land is not subject to depreciation. So it will continue to be recognized at historical cost, whatever the price you pay, 50,000 rupees. So what will happen is that even after 30 years, you continue to have it at 50,000 rupees. 30 years ago, 50,000 rupees is quite a big amount, but not in the current context. So when you look at your SOFP, there is a piece of land for 50,000, and you will think when you look at it, what exactly is this land doing for 50,000 rupees? Because in the current context, it's a very, very undervalued piece of land. So what is the problem here? The problem is we are not showing the real value of our land. We are showing a value which is way below the market value. In other words, our financial statements will not represent a true and fair view. One of the main things in accounting is that we need to ensure that there is a true and fair view of what we are doing, of the organization's affairs. And if we don't satisfy that condition, the financial statements are not going to be very helpful for the users in their decision making. So this is when the revaluation is going to be very, very critical. It will ensure that your assets are in line with their market values. It will ensure that the asset values that are shown in the financial statements are realistic and the values are reasonable. So how are we going to do a revaluation? When we are doing a revaluation, there are some adjustments that we are supposed to do. The first thing to remember is that we are supposed to clear the accumulated depreciation and transfer everything that is there in accumulated depreciation into the revaluation reserve. Transfer everything that is there. That means accumulated depreciation account will end up with a zero balance. You nullify it, you make it zero. And then the cost account, adjust the cost account to equal the revalued amount. You take the balance in the cost, the historical cost, compare it with the revalued amount. Any difference, you adjust it through the revaluation reserve. Any difference to be transferred to the revaluation reserve. So what's important here is that once these two adjustments are done, accumulated depreciation will be zero, cost account will have a balance which is equal to the revalued amount. After doing the adjustment, at every accounting period we are supposed to calculate depreciation. And how will this depreciation will be calculated? Calculate depreciation after revaluation using the revalued amount. Using the revalued, the new amount will be used to calculate the depreciation element. Let's take a look at an example. On 1st of January 2008, a machine was purchased for $600,000. Useful life 10 years. On 1st of January 2011, it was revalued to $560,000, and again on 1st of January 2013, it was revalued to $250,000. Calculate the relevant revaluation gain or loss for the above. As you can see, there are two valuations that take place. First one happening on 1st of January 2011, the second one happening on 1st of January 2013. So let's take a look at the first situation, 1st of January 2011. Now between the date of purchase, 1st of January 2008 and 2011, we have completed 2008, 9 and 10. We have completed 3 years. The asset has already experienced depreciation for 3 years. So let's take a look at the calculation. At 1st of January 2011, the revalued amount is $560,000. That's your market value. Market value is $560,000. But when you look at the carrying value, the value that we have in the financial statements, cost is $600,000, useful life is 10 years, already depreciated for 3 years, accumulated depreciation is $180,000. So that gives us a net carrying value of $420,000. So when you compare the carrying value of $420,000 with the revalued amount of $560,000, you can see that there is a revalued gain of $140,000. Revaluation is for $560,000, net carrying value is $420,000. So as you can see, the carrying value is less than the revalued amount. So what are we going to do? We need to increase the value of the asset. Now remember the steps involved. We have to clear our depreciation account. How much are we having in the depreciation account? 3 years of depreciation, $180,000 is there in the depreciation account. So we take it out, debit the accumulated depreciation account for $180,000. Then again, the next step says to make sure the balance in the cost account is in line with the revalued amount. Cost account balance, as you can see, is $600,000. Revalued amount is $560,000. So the cost account is $40,000 more than the revalued amount, $600,000 and $560,000. So we need to reduce it down. $600,000 needs to be reduced down to $560,000. So $40,000 we record it as a credit. So debit $180,000, accumulated depreciation, credit cost account, asset account, $40,000. Then we have the difference, $140,000. What are we going to do with that? This $140,000 is the revaluation gain which we originally accounted, which we originally calculated. So this gain of $140,000 will end up in the revaluation reserve account. And when you do the second valuation happens on 1st of January 2013. The revalued amount comes to $250,000 this time. Let's take a look at the net carrying value. Remember, the second valuation happens 2 years after the first valuation. So cost is $560,000. Why is it $560,000? Because we changed the cost from $600,000 to $560,000 after the first revaluation. Accumulated depreciation, $560,000 over 2 years. Remaining life at the end of the first revaluation was 7 years. So you have depreciated for $160,000. You get a carrying value of $400,000, and then you end up with a revaluation loss of $150,000. So the adjustment will be to reduce the asset value down to $250,000, remove the depreciation, debiting accumulated depreciation by $160,000, take it out, reduce the asset value from $560,000 to $250,000, take it down by $310,000. And how are we going to account for the loss? Remember, we do have a revaluation gain that we recognized before. Gain is for $140,000. When you have a revaluation gain and if you have a subsequent revaluation loss, the loss needs to be charged against the revaluation gain first. Charge it against the gain, anything excess will go to the income statement. So the double entry will be debit accumulated depreciation 160,000, debit revaluation reserve 140,000, debit income statement 10,000, credit asset account for 310,000. So that's IAS 16 for you all. So today in this episode, we discussed about international aspects of taxation, how the corporate residence is determined, and then we looked at some key accounting standard, and we started by the discussion of IAS 16. So thank you very much for joining with me. We look forward to meet you again in the next episode, where we will be discussing more on the accounting standard side of things. Thank you very much.